Well, it just so happens that our next guest has been saying that it is time to start pulling back from emerging market stocks. She is Kate Warne of Edward Jones. She's the chief investment strategist there, and she joins us now here live in the studio. Fast Forward. Kate, welcome to Fast Forward. Now, one of the things you talk about in your last report that you put out was that we saw this big trade into risky asset classes since the bottom.
Yes, absolutely.
You think that trade is overdone at this point, and people should be looking for value.
Yes, because the first phase of any kind of market rebound tends to be when the riskiest stocks do the best. And at this stage where we see countries around the world raising interest rates and the end of QE2 here with the Fed basically taking the first step to remove monetary stimulus, and as well as the fact that we're seeing budget cuts around the world, austerity is in style. Those say to us, this is a time to look at your portfolio, and if the things that have done the best are risky, it's probably a good time to put money into more conservative equities. So it's not stocks to bonds, it's risky stocks to less risky stocks.
Now, there are a lot of big names out there that talk about emerging markets as representing a lot of the value, and I know you're looking at valuations. You're looking at earnings versus where these stocks are currently trading versus earnings, and it does certainly seem as if emerging market stocks by that metric are overpriced. However, many would argue that it's more forward-looking valuation that you should apply, like Mark Mobius just very recently saying he still thinks there is a lot of opportunity in emerging market stocks.
Well, if you take a look at the rebound we've seen in emerging market stocks, they're up 150%. In fact, a little more. It's about 160% since their lows in March of 2009. Earnings are up about 75%. That says the valuations are getting stretched. Now, you're absolutely correct that it's the growth going forward, but what you always want to be careful of is not overpaying for that growth. We think right now you're probably overpaying for the growth.
Now, you really do a lot of stock picking. Tell me what stocks you like at this stage in time. I know Johnson & Johnson is one of them. That's a somewhat controversial name.
Yes, we like companies that have a track record of growing their earnings, paying dividends, and increasing the dividends, because we think that those tend to be the ones that have sort of gotten left behind in this first phase of the rally, so they're better valued. And as the markets get more volatile, they're likely to be the ones that turn out to, on a risk-adjusted basis, perform better. So they're going to be, rising slowly over time. And if the markets just stay sideways, you're getting that good dividend yield. So you're right. Johnson & Johnson's one of them. PepsiCo is another. Intel's the third. But you mentioned J&J's controversial. Yes, it's some of that controversy. It's some of the concerns that people have had about the production of the prescription drugs.
Right. There's been a lot of headline risk with that particular stock. Another one, Intel,
yes,
is a stock as well that's had a decent amount of headline risk, if you will. And Goldman Sachs, the analyst there, just cut that company to a sell the other day. What is it about this company that you like?
We actually like the fact that people are negative on it. That says the price is low, and if they're able to deliver on what they think is going to be 10% growth in the PC market, and they certainly delivered in the first quarter earnings report, then what you're going to get is the opportunity to buy a really solid long-term performing company at a very attractive price, as well as the fact the dividend yield's almost 4%. So that gives investors something they can count on, as well as the potential for better stock price appreciation.
I've got to ask you, financial stocks. We've been talking about them for the better part of the month. We're right at the beginning of June, so not too long, but they've been beaten up.
Yes.
Any stocks within that sector that you like, or are you staying away from that?
No, we do like some of the stocks within financials, but there you have to be very selective. We like the companies that have been allowed to increase their dividends, like JP Chase. In other words, basically you're looking for the strongest performers that have the opportunity to grow their business. One of the concerns has been that we're not seeing loan growth, that we're just seeing the earnings come from basically the money they set aside for bad loans. And what we're looking for is where are they going to get the growth, and we think some of the stronger performers are the ones that are likely to have the growth. So we would be putting money there, but we're a little cautious on it, partly because that's the best performing sector since, of course, the bottom in March of 2009. You take a look at the best performers, you want to really be looking in some other areas.
And quickly, Kate, we've got about 10 seconds here. Where do you think the S&P is going to end up at the end of the year? Is this just a short-term pullback?
We think it'll be higher at the end of the year. This is a short-term pullback, but of course no one ever knows. We could see bad news come in, things down, but we think overall the underlying earnings growth, the economic growth is going to remain sluggish but solid. That's going to drive stocks higher.
All right, Kate, that fits in with your theme. Investing is a marathon. That's from your latest report, not, of course, a sprint. All right, thanks so much, Kate, for joining us. That was Kate Warne, investment strategist at Edward Jones.